You've spent years building your portfolio, the equity is there. The growth is real. But then comes the moment of truth. You sell, and suddenly the IRS wants their cut. We're talking capital gains, depreciation, recapture, a massive chunk of your hard-earned profit gone. It feels like a success tax. The better you do, the more they take. Now, most investors think they have the answer. They use the 1031 exchange. They swap one asset for another to defer the tax. But here is the cold, hard truth. A 1031 exchange isn't a solution. It's a delay. You aren't eliminating the tax. You're just kicking the can down the road. You're building a massive tax liability that will eventually hit you or your heirs like a freight train. You're not actually growing your net worth. You're just managing a loan from the government that you can never truly pay off without losing a fortune. It's a loop of endless swapping just to avoid a bill. You're trapped in a cycle of deferment. But what if you could stop deferring and start erasing? Most investors think the goal is just to make money, but the wealthy know the real game is keeping it. To hit that $0 tax mark, you need more than just one strategy. You need a loop. Let's start with the first gear, the 1031 exchange. Most of you know this. You sell a rental property, you reinvest the profit into a like-kind property, and you defer your capital gains taxes. It's powerful. It allows you to snowball your equity without the IRS taking a 20% cut every time you trade up. But here is the problem. A 1031 exchange is just a delay. It's a tax loan from the government. If you hold that property until you die, your heirs get a step up in basis and the tax vanishes. But if you want to liquidate now, you're still on the hook. That is why you need the second gear, cost segregation. Normally, the IRS makes you depreciate residential property over 27.5 years. It's slow, it's boring, and it doesn't help your cash flow today. Cost segregation changes the rules. Instead of treating the building as one giant block, a cost segregation study breaks it down into components. Things like specialty lighting or luxury flooring aren't buildings. They are personal property. These can be depreciated over 5 or 15 years instead of 27. Now here is where the loop closes. Imagine you 1031 into a $2 million multifamily complex. You've deferred your gains. Now you perform a cost segregation study on that new acquisition. Suddenly, you create a massive paper loss in year one. Let's say that study finds $300,000 in accelerated depreciation. On your tax return, it looks like you lost money. But in your bank account, your rent is still hitting. Your equity is still growing. You are using a legal accounting fiction to wipe out your taxable income. This is how HNWIs scale. They use the 1031 to grow the empire and cost segregation to fund the lifestyle. To pull this off, you can't use a basic spreadsheet. You need precision. If your bookkeeping is messy, you're leaving 6 figures on the table. This is why elite investors use dedicated wealth management platforms to track every cent of that depreciation. Now, executing this loop requires precision. You can't wing your bookkeeping when the IRS is watching. That's why the pros use QuickBooks for real estate. It keeps your depreciation schedules and 1031 timelines airtight. Pair that with a dedicated tax planning platform to simulate your savings before you ever pull the trigger. The result? You stop guessing. You move from hoping for a tax break to engineering a $0 bill. This is how you preserve equity and scale your portfolio without the tax drag. If you're ready to stop overpaying the government, check the links in the description for the exact tools we use to manage these loops. And if this strategy just saved you thousands, hit the like button and subscribe. We're uncovering the wealth secrets the 1% usually keep quiet.